Welcome to the Sloth Investor podcast with your host, Mr. Sloth.
Welcome everyone to episode 25 of the Sloth Investor podcast. Jay and I are delighted this week to be joined by Brian Feroldi. Brian Feroldi is a YouTuber, financial educator, and he has written numerous articles for the Motley Fool. We're really excited for episode 25 of the Sloth Investor podcast. Brian, how are you?
Roy and Jay, thanks so much for having me. Great to be here.
Fantastic. So, Brian, can you perhaps begin by telling us a little bit about how you got started in terms of your investing journey? Okay, we're really intrigued to know, how did you get started upon your investing journey?
Sure. Like so many people, I was taught nothing formally about investing, the stock market, personal finance, anything like that. I was fortunate in that my parents were great role models on the personal finance side. They were very conservative with their money. They tended to buy things that were cheaper. So they were good role models purely from a personal finance standpoint. But they did not teach us much at all about the investing side of the equation. When I graduated from college in 2004, I knew absolutely nothing about the stock market. And I say that as someone that graduated with a degree in business. I graduated with a degree in business, and I was completely ignorant to the stock market. We never covered anything about the stock market in business school. We covered accounting, we covered marketing, we covered legal, we covered business strategy, and et cetera. Nothing about the stock market, which is just crazy.
And you're talking in post-secondary, you never learned anything about it.
Correct. Yep. And by the way, this is very similar to, I got a graduate degree in finance, and we went a little bit more into it, but none of the basics. We skipped over a lot of the basics. Now, for whatever reason, I was hardwired at birth to be interested in the stock market. I just didn't know it until after I graduated from college. The first book that kind of kickstarted my love affair with investing and personal finance was Rich Dad, Poor Dad by Robert Kiyosaki. That was very much a gateway drug into getting me into the subject, interested in the subject. And from there, I just read everything that I could possibly get my hands on related to investing. So books by and about Warren Buffett, Peter Lynch, Seth Klarman, Jack Bogle, the Motley Fool, etc. And that was in 2004 that happened. And I just instantly became very, very interested in anything related to money and finance. And I spent a huge amount of my free time studying markets. So that's how it all began roughly 20 years ago.
So a passion for you, essentially.
Mm-hmm. Exactly.
Brilliant. And Brian, could you touch on a little for us your first exposure to the Dow Jones as a golf caddy in high school? And I know you mentioned this early on in your book, but for those who aren't familiar with your book, who have not been fortunate enough to buy it yet, tell us a little bit about that experience as a golf caddy in high school and the connection to the Dow Jones, for example.
Yeah, like so many people, I came across the stock market sometimes growing up. Maybe the Dow or the Nasdaq was doing something spectacular, such as reaching an all-time high or plunging in the wake of the terrorist attacks of 2001, right? We all have these little moments in our lives when we're exposed to the stock market in some way. And for me, the one that I remember the most was when I was a caddy at a local country club. So this country club had a tournament, and I was a caddy for a couple of the golfers there. I didn't know. I was just looking to, carry their clubs around and get a tip. Well, at the turn, so after the ninth hole, they all went in, got themselves some food and some drinks. And this was on a work day. So when they came out, one of the golfers had a big smile on his face, and he said to the other golfers, "You're not going to believe this. The Dow is up like 300 points today." Right? And all of their faces lit up. They were all like, "No way, like you're not kidding." And they were like, obviously very excited by the market's movement. I had no idea what the Dow Jones Industrial Average was. I had no idea what a point was. But obviously this thing going up was good news, and perhaps it increased my chances of getting a tip and from my caddying that day. I think that a lot of people have an experience similar to that. If you watch the news, typically the thing that they talk about when it relates to the stock market is what the Dow Jones did that day, right? Did it go up that day? Did it go down that day? Yet I never heard it explained to me what the Dow Jones is, why it moved up and down, and what that even means for everyday people. So I had several stories like that growing up when I heard about the market, and I just immediately shut down because I was like, don't know what any of those words mean.
Absolutely. I mean, I have a similar experience because growing up in the UK, invariably when the stock market was mentioned, it would be in a negative sense. It would be, oh, the S&P has fallen by, so many thousand points today, or the Dow Jones has fallen. And it makes me think of a great book by Hans Rosling that I read within the last few years called Factfulness. And he talks about how invariably the news is skewed towards the negative. So when there were those momentary occasions when the stock market was mentioned within the British news press and on TV, for example, it would be in a negative sense. So for me, even into my teens and early 20s, there was no way I would be touching the stock market. It wouldn't go near a barge pole. And it wasn't until I met my wife's father, Mr. Sloth's father, if you like. He got started, he got talking to me about investing, and I would be honest with you, I was still quite cynical, and I thought, oh, I don't know about this. There's no prior family background of investing. Invariably the talk of investing is negative in the British news media. And he finally convinced me and had that long-term mindset, be patient and just be pragmatic, and spoke to me about Jack Bogle and Warren Buffett. And finally, that was what convinced me. And I love your story because for me, it speaks to the importance of serendipity. And I think sometimes we don't appreciate the role that serendipity plays in our lives. Obviously, for you as a golf caddy, for me, meeting my wife's father for the first time. And I guess we've all got those stories of
we've all got our moments.
Yeah, we've all got those golden nugget moments that really are, sliding doors moments, if you like, that really change our life in that respect. So it's fascinating.
For sure. And that's really sad, because what if one of those serendipitous moments don't happen to you, or it happens to you when you're 60 years old and all of the years or decades of compounding are now behind you? I was lucky. The serendipitous moment for me was really when my dad handed me a copy of Rich Dad, Poor Dad. And for whatever reason, I just had a predisposition to be interested in the subject. If he handed that to me a couple years before and I wasn't ready for it, I never would have read it, right? Or what happens if he handed that to me and I just, for whatever, I wasn't interested in the subject, right? I wouldn't have ever dove into it, or perhaps I would have dove into it 5 years too late. And maybe at that point it would have been 2008. And if I got into the markets in 2008, I would have been like, this is awful. This is terrible. Like, investing doesn't work. Anything you buy just goes down, right? The random chance of when you get in the market does shape your views of the market essentially for the rest of your life. So yeah, it's terrible that serendipity really plays a huge role in how you handle money for the rest of your life.
Yeah. Ironically, it's funny you should mention that, because I started probably investing in the year 2000 when I first moved to Hong Kong. And there was a big sell-off, and I got spooked, of course. And when everything bottomed out, I sold everything, thinking, "Oh, I'll be a smart investor and just re-enter the market after everything's done bottoming out." And of course, had I held on to everything back in the year 2000, I would be a much richer man than I am today, and probably be Roy's landlord. But such is life. And of course, I thought, I don't know what I'm doing. I'm going to go to a financial advisor, who turned out to be someone who was just essentially a wolf in sheep's clothing kind of thing. And it wasn't until I turned 40 that I discovered I don't need a personal financial investor to do these things for me. I can do it myself. I can manage it myself. And you talked about sort of your golden moment. My golden moment was reading Andrew Hellam's book, and that was sort of my turning point. But it didn't occur to me until I was 40.
Wow.
And I think that's unfortunately a bit late in the game, that I'm trying to help people with this podcast, my own children, avoid that moment too late in life, because financial literacy is such a lifelong skill that I think we need to be sharing with people.
Sure. The good news is 40 isn't too late to get started. It's just, it's obviously would have been better to get started when you're 30 or when you're 20 or when you're 10. But yeah, the best way to react to that is to do exactly what you're doing, which is educate other people, and especially your kids.
Absolutely. So Brian, you mentioned a moment ago with regards to your experience as a golf caddy, the Dow Jones. And I know that something that can flummox certain people is the kind of the terminology that surrounds investing, such as, for example, the S&P 500, Nasdaq, Wall Street and so on. So perhaps would you like to give kind of like a bit of a kind of a deeper dive into terms such as the Nasdaq and S&P 500? If this is the very first time they're tuning into the Sloth Investor podcast, what is the Nasdaq and what is the S&P 500?
Yeah, so let's take it one step back. I think it's the most helpful to start with the Dow Jones Industrial Average, because that is the indices that really kicked off all other indices. And once you understand the history of it, it makes so much sense why we call it that and what it exists. So rewind the clock to 1896 in the United States. At that time, there were publicly traded companies the same as there are today. A lot of the publicly traded companies at the time were railroads, utilities, banks, and the like. So there weren't as many publicly traded companies, but they did exist. Well, every day, the way people got information about those publicly traded companies is they would read the newspaper, specifically the Wall Street Journal. That was a very popular news back then, just like it was today. Well, the editor of the Wall Street Journal, his name was Charles Dow. And he became frustrated because every day he was printing tables and tables and tables of stocks and what their stock did that day. But these tables made no sense to so many people. And there was no way that he could summarize what happened in the market that day, that week, that year for his readers, because all people saw was tables and rows of numbers without any context to them. So he worked with his friend, who was a statistician. His name was Edward Jones. And the two of them devised a very elegant solution to this problem. What they did was they took the 12 largest industrial companies of the day and they added up each of their closing share prices. Then they took that number and they divided it by 12. So they added up the share price of 12 companies that were very well known. They divided by 12. And what's it called when you add up a bunch of numbers and then divide by that same number? That's called averaging. And they launched the Dow Jones Industrial Average. And they then could report this number to their readers every single day, and it would give a better idea to their readers for what happened to stock prices that day. So this small sampling of just 12 companies was used as a barometer for figuring out what happened, broadly speaking, to stocks that day. Now, the Dow Jones Industrial Average quickly caught on with investors, and they would look to this number to get a sense for what happened in the market. And that number has been reported every single day since 1896, and it's still one of those widely quoted indices in the world. Now, we live in a capitalist society, and in 1923, a competitor to the Dow Jones Industrial Average was launched by a company called Standard Statistics. Rather than using 12 companies, they used 233. Over time, the Standard Statistics merged with a company called Poor's Publishing, and they decided to expand their list from 233 companies to 500. Giving launch to the Standard & Poor's 500, or S&P 500. Now, the S&P had two big advantages over the Dow Jones Industrial Average. First, it measured 500 companies, not just 12. Now, the Dow eventually became 30 companies, but you could make an argument that measuring 500 companies is a much broader swath of what happened with the markets than just 30. The second big innovation was, rather than using the share price to calculate the indice's movement, they weighed their index by company size, by using a metric called market capitalization. So by doing so, large companies, the biggest companies out there, would have more influence over what happened to the price of this S&P than the Dow Jones, which simply used a share price, which is just an arbitrary number. So those two changes really caught on with Wall Street eventually, and the S&P 500 today is now the yardstick that most professional managers measure their returns against when compared to the Dow Jones Industrial Average. One more in there. In 1971, a brand new computer index was launched. A brand new stock exchange was launched called the National Association of Security Dealers Automated Quotations, or Nasdaq. And this was simply an electronic exchange that people people could use to buy and sell stocks with each other. This exchange also launched its own index that tracked all of the stock prices of the companies that were traded on this. And this was called the Nasdaq, which launched in 1971. So you have it. That is why there are now three most popular indices in the world: the Dow Jones Industrial Average, the S&P 500, and the Nasdaq, and why they exist. They simply provide context to investors, where a small sampling of companies gives numbers behind what happened with the market that day, that week, that quarter, that year, that decade.
You and I've got a great question for you. As you were talking, and you use the term, you're a financial educator, which I love, actually. My daughter was asking me a question about the stock market, and I was all happy because she's finally coming around to showing some interest about investment. And she asked me, she said, well, why would anybody want to own a stock? And I thought, I actually don't have the answer to that. I don't know how to summarize that up. I don't know how to put that into words. What would you say to that?
There's really only one reason to own a stock, and that is
to make money.
To make money. To grow your wealth over time. I mean, technically, there are more reasons than that. Some companies buy out other companies for strategic reasons, because they want to get access to talent or IP or infrastructure or whatever. But that's at the company level when they're buying out an entire business. For us, the individual investors, the only reason to invest your money, which is taking savings that you have, putting it into a business or an index fund, aka at risk, delaying consumption, and then hoping that the final result of all that is an increase in your purchasing power. Why would you go through that arduous process if there wasn't some prize at the end of it? And the prize at the end of it is your money makes more money for you. Your money is used to grow your wealth over time without you having to exert your own physical labor behind it. But that's the reason that people buy stocks, because they want to increase their wealth through the prosperity of other businesses.
Brian, as well, there's a phrase that really resonated there with me from what you said. You mentioned the phrase delaying consumption. And for me, that's critical. But yeah, it's fascinating because in terms of Jay, your daughter, teens, right? And I have kids, 5, 8 years old. And I just think in terms of, we think ironically about, the FANG stocks, if you like, Facebook, Amazon, Apple, Netflix, Google. And, the record speaks for itself over the past 10, 15 years. But it's fascinating for me how you could argue that, those stocks in particular, like Whisper of Amazon and Netflix and so on, how they've kind of conditioned us to immediate gratification. And yet, for me, like you say, it's critically key that in order to achieve success in the stock market, we delay consumption. So I think even though within our daily lives, we can watch a Friends episode, binge from Friends episodes one after another, and watch the latest movie and so on. It's critically key that young people of any age understand that ability to be patient, to be sloth-like, to delay consumption is so important. And
previously, I would have had I been going through this current sell-off in the market, that's been going on, I would have gotten out and I would have sold everything and said, "Oh, I'm out." But experience is the best teacher, right? I've been through this before, and my hope is, of course, my portfolio recovers. But
dealing with the emotions that the market is going to put you on if you invest for any period of time is extremely challenging. But I think one of the big reasons why so many people invest the wrong way is they literally don't know what a stock is, what the stock market is, and they literally don't know why stocks have value and what drives value in the long term. I didn't know that when I first started. I thought stocks were just random number generators on a screen that you traded in and out of in order to steal money from the company or from somebody else. It made absolutely no sense to me why these things had value and why they increased and decreased in value over time. Once you back up and understand that these are enterprises that create profits belong to the shareholders, and as go the company's profits in the long term, so too does that stock price. That gives you the mental fortitude to hold when everything is collapsing around you, because you can actually see to yourself, well, I own a stock. If the business eventually recovers from this, so too will the stock price. So intuitively that buying and holding does work over long periods of time. But that's because you've internalized that you actually know what a stock is. So many people don't even know what a stock is.
And Brian, in terms of you as a financial educator, and when I read your writing and when I access your Twitter feed, something that really resonates with me in terms of you as kind of this, as a financial educator, is your sense of humility. So if I were to replace the H in my Sloth acronym, of course it's headstrong, but if I were to replace it with another H, it would be humility, because I think it's really key that investors do show humility and accept their own circle of competence, to use a Buffett phrase. And I like the fact that you have, whether it's via Twitter or through podcasts or in your book, you have spoken about, your investor mistakes. So perhaps would you like to take a little bit of time now to kind of touch upon, are there any particular mistakes that you think our listeners could really learn from and could really, help them in terms of their own kind of investing palette? So are there investing mistakes that you would like to share with our listeners?
Oh, I've made so many investing mistakes. I mean, I personally am a big fan of individual stock analysis and individual stock investing. That's because I enjoy following the markets. I enjoy analyzing businesses. I enjoy everything about investing. That makes me weird, like very, very weird. The reason that I recommend index funds to 99% of people is because I know that 99% of people have no interest in following the market, in studying businesses, and reading conference calls, in analyzing their own psychology. They have no interest in the markets at all, which is perfectly fine. Just dollar cost average in index funds, call it a day. Understand the basics. But I have made a tremendous amount of mistakes on an individual level. And if you're going to invest in individual stocks, it requires a whole nother set of skills, a whole nother set of learnings, and a whole nother level of patience. So some of the major mistakes that I made, number one, by far, the most expensive mistake by far, is selling a mega winner early. Selling the next Amazon, the next Microsoft, the next whatever early. And I've done that more times than I care to admit. I actually sold Microsoft in 2010 at $24 a share. And the current price is $246. So I missed out on a 10 bagger on Microsoft, right? Not some small penny cap stock that nobody's ever heard of. On Microsoft, I missed out on a 10 bagger on it. Why? Because I bought it at 20, it got to 24, and I said, all right, 20% gain. I'll take it. Not really caring or thinking about the long-term trajectory of the business.
Same thing happened with me and Tesla. I did the same thing happened when I had Tesla. I sold Tesla way too early.
There you
years
go.
ago.
There you go. I sold a company called Dexcom in 2009 for about, split adjusted $2 per share. Currently, it's 103. So that was a 50 bagger and counting. I sold Activision Blizzard at 12. I think Microsoft just bought them out at 78. Right? So these are companies that I did the research. I put my capital at risk. I bought, and I was in a rush to take a profit, even though I was right. So while I've bought so many losers, right? So many times that I bought and then they went down 50, 70% and I lost money out of them, right? That's going to happen if you invest, period. But those mistakes, I don't view as my biggest mistakes. My biggest wealth destruction mistakes were selling great companies early.
Fascinating. I remember years ago, it must have been perhaps 7 or 8 years ago, receiving a paper newsletter from the Motley Fool, and it was a statement from Tom and David Gardner, and they literally had a very similar kind of rationale to what they said in the letter. They focused upon what if they had never sold a single one of their stocks, and they came to the conclusion, so they had some winners and plenty of losers, but if they had never sold a single stock, I mean, the outcomes would have been even more incredible for the Gardner brothers. So it just speaks to what you're saying there, Brian. It really does. Yeah. Absolutely.
And the crazy thing about that is, if I know exactly what you're talking about, their accuracy with selling decision is very, very high. Like they are selling is the right decision 85% of the time, 90% of the time. But if they sell, I think the big one for them was ARM Holdings. ARM Holdings, they sold, and then that company like 30x'd. Right. So it's a much bigger mistake. I've learned the hard way to sell it's much bigger mistake to sell a future winner early than it is to hold a future loser for too long.
Sure.
Can I ask, did you have any, you were obviously investing during the .com crash.
I was not. I was investing right after that. So I started buying and selling stocks in 2004. But I remember seeing on the news, like in 2001, September 11, 2001, I was glued to CNN just like everybody else in the world at that time. And I remember a couple of days later when markets opened, they were just like crashing, right? And this was before the stock market had already peaked and it was already going down for like a year. So I remember seeing the carnage to the dot-com crash. I wasn't investing then, but I remember being like, oh, that sucks. Obviously, this is Osama bin Laden's fault, or it's President Bush's fault, or whoever. I was looking for someone to blame, just like everybody else, not actually realizing this is how markets should work.
Yeah. Now, Brian, obviously, we know at the moment, it's October 2022. There's a lot of turmoil, a lot of discussion about, oil prices, Russia, Ukraine, and inflation so on around the world. For our listeners, perhaps there are those listeners who want to know, why has the stock market always recovered from crashes? So invariably we know from what I spoke about earlier in terms of Hans Rosling and his book Fact This, that invariably there's that inherent tilt towards negativity within the media. But why does the stock market ultimately, fundamentally always rebound? Why does it always recover from crashes? What would be your thinking there?
Yep. So if you look back at the long-term chart of the Dow, the Nasdaq, the S&P 500, it's very clear what the trend is, right? It's up and to the right. It's a very bumpy ride, and there are definite periods when the stock market just takes a beating, but the long-term trend is undeniably up and to the right. That never made sense to me. Never made sense to me why the stock market defies gravity and just continually goes up. And this was especially true in 2008, right? Banks were collapsing. People were saying this is the Great Depression Part 2. People were getting laid off like crazy. They were getting kicked out of their houses. There was tons and tons of leverage in the system. The government's balance sheet exploded as they had to save the car industry and the financial industry and like AIG. And it was chaos. It was just chaos everywhere. And yet the stock market eventually bottomed, eventually recovered, and eventually went on to hit a new high. Why? Why the heck does that happen? And why has it historically always happened? Yeah. There's a couple of things that happen during economic crises that actually set the stage for a recovery to happen. First and foremost is that tough times force innovation. They force innovation. When times are tough, companies are forced to try new business practices, to adopt new business models, to do things differently than they were done before, because they have to change, right? People are generally very resistant to change, but when there's an economic shock, they're all of a sudden forced to change. Secondly, when tough times hit, people get laid off, and those people that are laid off often become entrepreneurs. They start new businesses to take advantage of opportunities that they see. Same thing with the individual side. If you have a nice cushy job, everything's going well, you don't have an impetus to really act, right? But if you get laid off, all of a sudden people are willing to take on new jobs, to take risks because they don't have any alternative, or it gives them the push to do so. Secondly, in bad times, bad businesses go belly up. Companies that should never have been funded die, right? The weakest companies in certain industries die. And that allows the strong companies in those industries to come in and acquire assets on the cheap, to pick up market share, to acquire customers. It also provides a fertile ground for new companies to get a foothold in an industry with new ideas. Third, the government usually eventually steps in to provide some kind of assistance, right? So there could be public work programs, there could be direct payments, there could be loans that are given out. The government obviously hates it when people go through bad economic times because that's bad for voting. So the government usually steps in to provide some kind of assistance to jumpstart things. I view downturns as kind of like a forest fire, right? It's awful when the forest fire is coming through. But what happens in a forest fire, those are actually healthy for the forest in the long term. They get rid of the brush, they kill off the weakest of the trees, and only the strong, resilient trees grow. And that creates an unbelievable amount of fertilizer that allows new things to come up, and the forest replenishes itself. The business cycle, the business works the exact same way. The economy works the exact same way. How many silly businesses got funding in 2020 and 2021 that should not have gotten funding, at least not at the valuations that they did so? I don't know the number. It's a lot, right? It's a lot. How many companies are getting funding today? Very, very few, but you can bet that the companies that are actually being funded today are likely to be much higher quality businesses than were being funded 2 years ago. So bad times pave the way, set the stage for a new crop of companies to come up, a new set of innovations to come up that eventually leads to a recovery in profits, and a recovery in profit eventually leads to a recovery in the stock market.
It's fantastic. And for me, this is something I've mentioned before on a podcast in terms of, I know Morgan Housel, who you'll be familiar with, Morgan Housel's mentioned this too, particularly within the psychology of money, very, best-selling book from Morgan, is really, fundamentally, it's not economics, it's not mathematics or accounting. Two of the key disciplines that investors need to possess are psychology and our history. In terms of what you're talking about there is that, the stock market invariably does bounce back. And in terms of the psychological aspect, optimism, optimism is key. I think we even devoted an entire episode to optimism, didn't we, Jay, at the beginning of the year? It's so critically key. And so to any listeners, out there, checking out this podcast, listen to Brian and what he's talking about in terms of optimism, and that the stock market will eventually bounce back. And it's just about that adhering to that long-term patient mindset. Really, really is indeed.
I had to change my mindset and tell myself eventually this is going to happen, and prepare myself mentally. When you prepared yourself mentally, and you tell yourself it's a natural part of the cycle, then it's a lot easier to deal with. And one of the things I've done, I've stopped checking daily the stock market for my own mental sanity, because I don't want to have any enticement to sell. I'm just parking it and leaving it and letting it ride right now.
Well, let me make a connection between the two of you, because what you just mentioned there, Jay, really, really, I want to make a link to, because Brian, I think I'm right in thinking that there was a tweet you sent out a few weeks ago. We mentioned that, why should you check the price of your stocks every day? You don't do it with your property. You wouldn't check the price of your property, would you? So there you go. Why would you do that with your stocks? And Jay, you came up with a term a while ago now in terms of, if you're checking your stocks on a particular day and it's deep red, you came up with this term daymare. And I love that, so that we know there's, and we know the phrase nightmare, of course, but, for those people who kind of, religiously have to check their stocks on a day-to-day basis, and they see the plunging red, and for them, it's like the equivalent of a daymare. Don't do it. Go out, enjoy it, spend time with your family, go to the beach, throw a ball, whatever, It
was becoming a nightmare during the day.
Well, yeah, exactly, but just get out and live your life,
It's so, investing is so akin to gardening.
Yes.
It's so akin to gardening, right? You plant some seeds, you water them, and are you going to go over to the garden and check every couple hours? Did it come out yet? Did it come out yet? Do we have leaves yet? Do we have fruit yet? Right? Everybody intuitively understands that's not how gardening works, right? If you want to grow an apple tree, you plant it, you put it out there, that water's going to come over it, that it's going to take years for the roots to grow. Eventually it's going to come up from the ground, it's going to be small, and then it's going to get bigger and bigger and bigger. And 10 years from now, it's going to have fruit. And then you're going to have so much fruit coming in from your seed that you planted 10 years ago. But it's like, it's the tricky thing about the nutty thing about investing is we get real-time feedback all the time. Every single day, you can get feedback about what your investment has done that second, right? You can get up to the second information on how you're doing as an investor. It's very tempting. It's so tempting to want to check that out. It's only when you realize that is literally just random noise. It's a hard thing to internalize, but that's all day-to-day stock price movements are. When I meet people in real life that find out what I do, they're like, "Oh, what'd the market do today?" And I'm like, "I don't know. I don't look at the market. I don't look at the market every day." And that confuses so many people. They're like, "I thought that you do investing. You didn't look at the market today." It's like, yeah, that's because I invest. I don't trade. I don't care what the market's doing on any given day. I always have a sense of what's happening in the macro and what's happened with the market recently, but I don't know what the market is going to do today. I don't know what the market did yesterday. That is immaterial to me. That doesn't matter to me. If the thing that matters to me is, did I buy great companies that are going to grow over the next 5 and 10 years? If the answer is yes, I'll be happy in 5 or 10 years time. But what path they take to get there is unpredictable.
Yeah, and I love that. I love your focus upon the word invest, the importance of investing. Now, I was back in the UK for the first time for 3 years this summer. We've had some kind of, very strict quarantines here in Hong Kong, but finally Jay was able to go back to Canada. I was back in the UK, and I happened to pick up a few newspapers, looked in the financial sections of these newspapers, and invariably, what did I see? When I made a contrast, when I did a kind of little private survey myself of the number of occurrences of the word invest and the number of occurrences of the word trade, what happened? So many more occurrences of the word trade. And I just thought to myself, man, if there's someone who's fresh and new to investing and they see that word trade used again and again and again, they're completely getting the wrong idea of what it means to be successful in the stock market. And we know why, because of course trading leads to more costs and more fees, and that's how the brokerages earn money. Okay, the guys in suits. But for me, it's just so critically important to focus upon that word invest. I even know my own brokerage, when I log in, I'm confronted with that word trade again and again and again. But it's just about people understanding that it's about investing, it's that long-term mindset, and it's not about trading, that's for sure. Yeah.
For somebody who wanted to get started, for the people who are listening right now, and they wanted to get started, what would you tell the person? What's the first thing you want to do to get started, to get yourself started in the investment journey? You can take care of yourself. Here's where you start.
Education.
And by that, what do you mean? Can you give us more detail?
Step one is educate yourself. If you don't have a financial education, and you can buy index funds and do terribly. Like you can dollar cost average into index funds, but if you don't have an education and you sell in March of 2009 or in March of 2020, or if you sell, what was the low this year? I don't know, July, August of this year, whatever the heck the low was this year. If you don't have a financial education and you have an uncle point where you sell at the absolute worst time, that is going to erase years of good financial decisions. So step one is to always start with educating yourself. Answer simple questions. What is the stock? What am I investing in? Why does this make a sound decision? Because the stock market is such a confusing thing. People intuitively understand bonds, right? You buy a bond index fund, it tells you the return right up front. You're going to get 5% on this bond over the next 10 years. That makes sense, right? People understand. I put money in a bank. The bank pays me 0.5% interest rate. That's the quote unquote return I get for investing my money, right? That makes sense. Bonds are a very logical evolution from that. To be like, all right, there's the return. There's the coupon that I get. I hold this thing. I get 5% per year for the next 10 years. Makes sense. Equities is a completely different thing. Stocks, right? Where is this magical 10% annualized return that I'm supposed to get if I invest in stocks over the long period of time? I was told that when I first started investing. Oh, stocks return about 10% every year for the last 100 years. I was like, where's this 10%? All I see is this. All I see is this, right? I see today I'm up 1%. Tomorrow I'm down 2%. The next day I'm up 1%. This magically equals 10% per year. So that is just so confusing. If you don't understand what the stock market is, if you don't have the basic education, the odds of you doing the wrong thing go up dramatically. So I say the first thing you should do is just educate yourself. And thankfully, never been easier to do so. Never been easier to do so. You can get a great financial education on Twitter, on podcasts, on YouTube. Heck, there are even some good people on TikTok that can teach you things in bite-sized numbers, right? The only downside to a free education is there's a whole bunch of noise that you have to just get rid of and not look for too. But to me, step one, always educate yourself.
Absolutely. And that leads us nicely into a question about children. So Brian, I understand you're a father. Jay and I both have kids. What advice or guidance do you have for your own children within the realm of investing? What would you do? Of course, making sure you're not overwhelming them with complex information and jargon too much, but what would be your basic first initial steps to get your kids started on the road to investing?
Well, so I have a cheat code of sorts that I use, and I'm actually going to be using it later today. So my kids are elementary school age / middle school age. And one thing that I've been doing with them for the last 5 years is I've offered to go into their elementary school, and I perform a education service about what the stock market is, what companies are, and we do a stock picking contest. Now, I think I do stock picking contests the right way. So many schools out there that do stock picking contests, like, let's pick a stock, and then we'll wait 3 weeks, and then we'll see how we did. And we all know that's useless. That's random information. Teaches them nothing about business or whatever. But I created a simple presentation. It's hyper optimized for engagement and fun. So we talk about Netflix versus YouTube. We talk about Nike versus Adidas. We talk about Amazon versus Etsy, right? We talk about, I show them a brand, this one they love. I put a brand up there and I say, who knows what this brand is? And they're like, Starbucks, McDonald's, Lululemon, right? And I'm like, do you know that you can become an owner of these companies? Do you know that if these companies do good, you can make money? And then I show them the simple compound interest behind that. So it's hyper optimized for fun. Now, the reason I'm doing it in the school is because my kids would never sit down to watch me do that at home. But if we're in a classroom setting and their friends are there, and I'm the fun dad that comes in to talk about TikTok and YouTube, all of a sudden education is fun. Now, here's the important part. I do this over a multi-year period, multi-year. So I come in the beginning of the school year, which is now. So I'm going in later today, and they pick their stocks, and then I come in 9 months later, and we see how we did. Most importantly, because I've done this for several years, I can say, well, let's see how our stock picks have done 1 year ago, 2 years ago, 3 years ago. And when they graduate, when they're 18, I can say, let's see how we did when we were in second grade, how our stock picks did when we were in second grade. That's, I think, how you hammer home, is by showing them examples. And then on top of that, I gift them stock for Christmas, right? So because I'm interested in this stuff, I try and sprinkle it in to conversations when we're driving down the road or when we're shopping for a grocery at the grocery store. But this stuff can be very boring if you present it one way. But I think if you hyper optimize for fun and make it relatable to them, that's how the lessons stick home.
I love that, fun and engage. And in terms of what you said about buying stock yourself, Jay, didn't you have a story about a certificate for your son or daughter?
Yeah. Something not too dissimilar. I don't buy my kids gifts anymore. I gift them I make the certificate, but that's exactly what I do. I give them certificates to the stock market. You know, you can choose this stock or this stock. Which one do you want to choose? And I'll buy it for you right now.
And like, I'll take a Berkshire Hathaway A share, please, Dad.
Yeah, exactly. A shares.
Get saving, Dad. Get saving.
I only want one.
Yep, I know, exactly. So Brian, in terms of my 5 bedrock principles, so simplicity, low fees, earning the world, time, and headstrong, I guess naturally we've touched upon some of those already, but is there would there be one in particular that really resonates with you deeply of those 5? What would you say is the one that really resonates with you the most?
I would assume that headstrong is akin to mindset and like the way that you approach and think about it. So that would be the one that I would harp on the most. You can keep things simple. You can keep fees low. You can own everything. You can have time on your side. But if you don't have the right mindset, you're still going to do poorly, right? If you don't understand what you're doing, why you're doing it, and understand the time frame that equities in particular need to be judged by, you're going to do wrong. But I love the framework that you put together.
Thank you very much. I appreciate that. Yeah. And in terms of who inspires you, I mean, we have something within the podcast called the Sloth Investor Hall of Fame. We've touched upon, for example, Jack Bogle and Buffett. I know that at some point you will very much probably make an entry in the Hall of Fame. But in terms of you as an investor, who has inspired you? Who do you look up to and admire as an investor?
There's lots of answers to that question. The way that I invest today has been influenced by dozens upon dozens of people. You can throw all the classic famous investors in there. If I had to put one up there that I appreciate listening to the most, it would probably be Charlie Munger, just because he doesn't hold anything back, tells it straight, will tell you that's idiotic, right? He could tell you, he even said recently, if I was starting today, I wouldn't have gotten the returns that I've gotten, right? He was lucky that he got started when he did, when nobody understood what equities were, when he could buy great companies at 3 times earnings, right? That just because he would do the math behind them. So there was an unfair analytical edge that existed 70 years ago that is now gone, right? So he understood these things when nobody else did. That is not as much of an edge anymore. But I think modern day investors that I really look up to would be David Gardner. For sure, he's had a massive impact on my investing mindset. Jeff Fisher, who's the hedge fund manager of the Motley Fool's kind of like hedge fund. He's one of the best investors I've ever met or talked to. His principles just really resonate with me. And then Terry Smith, who runs Fundsmith. He's an investor that I think is fantastic and just not one that many people know.
Sure. Yeah, out of the UK indeed, isn't he? Terry Smith, brilliant, fantastic.
And you've given me some food for thought too from people that I want to check up on as well. In terms of, looking for inspiration and looking for people to follow, how can people follow you? Like you're on a variety of different platforms. If people want to follow you, how do they follow you?
Yeah, pick a platform. I'm probably on it, but I'm most active on Twitter. Which is at Brian Feroldi. And if you're interested in my newsletter, that's once a week, an email of kind of nuggets that convince you to nudge to think long-term in every aspect of your life, not just investing. The name of that newsletter is Long-Term Mindset. And you can sign up by going to my website or following me on Twitter. There's links there.
That's fantastic. Brian,
what I like about your newsletter, before you go, what I really
go
like about it, you make it accessible for the average person.
Yeah.
What's the term? one graphic, one timeless piece of content, one Twitter thread, one resource, one quote. I like how that you put it together in small chunks and accessible chunks. It's not something that's overly technical to digest.
Thank you. I don't like dense stuff myself. My book is 62 chapters. Like the longest one is 4 pages long. I don't like dense stuff. Dense stuff doesn't get through to me. That's not how I like to. I enjoy consuming content in bite-sized chunks. So that's how I try and create my own content.
Well, it's working. It's working.
I mean, and Brian, you chose a moment ago my 5th bedrock principle. And if I was to link it back to you, for me, it's simplicity. When I think about the content that you provide, the one graphic, the resource, the Twitter thread, the quote, and so on, it is that simplicity, that less is more, like you say, short chapters, really critically key in terms of you being a profoundly important, influential, contemporary financial educator. So full marks to it. It's fantastic. It's been fantastic to talk to you as well, Brian. It really has,
There you have it, everybody. Thank you very much to Brian for checking in with us today, all the way in here in Hong Kong from New England. Quite a distance.
Thank you for making it work, Brian. We appreciate your time and we hope you have a lovely weekend coming up.
Right back at you, Jay and Roy. Thanks so much for having me.
It's been a pleasure, absolute pleasure. Thank you so much, Brian. So long for now.
For more tips, follow the Sloth Investor on Twitter at @Sloth_Investor.